All right. Hi, everyone. As Joe said, it's David Barnett, and we're going to get underway here. I opened up the chat box so that if anyone has any questions while we're going through the presentation, you can type it into the chat box if you wish, and there will be time at the end for questions and answers. Little bit of an intro for me. I was here last week, or last month rather, and so for those of you who haven't seen any of that stuff, my website is davidcbarnett.com, where I talk about buying, selling, financing, and managing small and medium-sized businesses. I manage a YouTube channel right now. It's closing in on 400 videos, all about buying and selling businesses, financing and managing them, things that people have sent in, viewers have sent in to me. I was the first person in New Brunswick to become certified as a business intermediary, and I ran the Sunbelt Business Brokers office in Moncton from 2009 until the end of 2011. And then I got out of business brokerage, and for a lot of different reasons. But while I owned that business brokerage office, I brokered the sale of 36 businesses here in the Maritimes. And now I work as what I call a private transaction advisor, where I help people buy and sell businesses on their own. And I work with people all over the world. More than half of my business is actually with Americans. So today we're going to be talking about buying businesses, and we're going to be talking about them from the point of view of a lender. And the slides that I'm going to show you today are actually an excerpt from an afternoon that I spent with the CBDC in Kent County here in New Brunswick. And it's based upon what I've seen and worked on behalf of lenders and from working with sellers. I'm going to actually tell you a couple of stories of some case studies and how they worked out really poorly for lenders, and some of the lessons we can learn from those cases for you guys in doing your own deals when people come to the CBDC looking for money to buy an existing business. But first of all, let's just look at this whole notion. Why would someone want to buy an existing business? Well, I think it's smart because you already have customers, and that means sales, and hopefully that means profits, which of course we know when you start a business from scratch, the biggest challenge is to get your sales up and running. And so it makes sense to buy something that's already going. But here are the risks that someone's going to face if they buy an existing business. A buyer could overborrow and buy a business, and then they can't meet their obligations. So they run into risk with being able to make the payments. A buyer could overinvest their own money into a business that is worth less than the amount that they paid. And I'll ask everyone, if you can, just to make sure that you hit mute when you join up so that we don't get background noise. And then the third thing, of course, is that a buyer buys a business which is not as good as he was led to believe. And we end up with a buyer suddenly realizing that things aren't as rosy as they were supposed to have been when a presentation was made to that buyer. What risk then comes into play for the CBDCs, for example, as lenders, right? So the danger for you guys is that you make a loan to a buyer who can't service the debt, or you take on collateral that's worth less than... Sorry, is someone, I can hear someone talking. Okay, so and I'm going to tell you guys a little story about a case that I actually worked on where there was a big mismatch between the actual value of the collateral and what was told to the lender. And of course, the lender puts themselves in a position where another party can press for a quick collateral liquidation to the detriment of the lender's interest. And I'm going to tell you a case study about this as well. And you guys probably, just in hearing me put these statements up here, are probably thinking of different stories that you've come across in your careers. So how does a buyer of a business protect themselves from these possible threats? And we're basically worried about themselves being overly optimistic and overpaying for something, believing it's worth more than it really is. And the other threat is that a seller is actually going to be devious and fraudulent and say things to get someone to buy some business that isn't as good as they claim. And there's basically three principal, colleagues or support people that protect these buyers. There's accountants, there's commercial lenders, people like you guys, and there's acquisition advisors, people like me, right? So if a buyer is going to buy a business, one of the things I'm always talking about is how you have to build the right team. And you'll notice that a lawyer isn't even on there, because a lot of these problems need to be discovered before a deal actually gets to the point of finding a lawyer. Because if the numbers don't make sense, we shouldn't be even in getting to the lawyer stage. The lawyer's there if we think we're going to do the deal, and then they're going to do another sort of level of due diligence and checking things out. So how do all of these different people help our buyer? Well, our accountant, they're going to help us do some due diligence and look at this business. They're going to be able to help determine if the books are wrong in some way. And they're going to help with cash flow projections, and they're going to help with the due diligence. And here's the big con. And I know a lot of the guys here in CBDCs work in small towns. And so you have a lot of small community-based advisors. Biggest con is that 95% of accountants are experts at financial statements and tax returns. They're not actually expert in the everyday challenges of helping someone do due diligence on a business acquisition. Very few of them are informed about the realities of small business valuation. I regularly deal with clients from all over North America who are sellers, for instance, that get their accountant to help them value the business. And then I have to explain why the accountant's number sometimes is 2 to 3 times higher than the realistic selling price of their business. And mostly it's because when an accountant studies accounting, the little bit of exposure they do have to business valuation usually comes from the sort of the pathway that leads to the CBV, the Certified Business Valuator program. And if you read their textbook, what it says in there is that a small business has revenues of $10 to $15 million. So it's very much an area that's dominated more by the middle market to larger businesses. And the problem is when you start to use methodologies developed for mid-market businesses and you apply them to small businesses, you almost always end up overvaluing the business. Just off the top of my head, I saw one the other day where an accountant had advised his client that businesses like his sold for a cap rate of 18% of cash flow, and which makes his business about twice as risky as a commercial apartment building or a commercial property. And what I had to show this person is that in actual fact, the cap rate for his type of business should have been closer to 40%. So in that one example, the number he was working with was more than double what other similar businesses like his had actually sold for in the past. Our next group are the lenders. So an experienced lender can tell if a deal doesn't make sense. And you guys have probably seen many of these things come across your desk where you know quite quickly that, no, this doesn't make sense. It's not a good deal. And you can deny a loan and stop a foolish buyer from making a bad deal, right? Sometimes some of the worst deals I've seen have actually been from new people coming to Canada from other countries who unfortunately have a lot of cash, and they never meet this lender because they just write a check, and then only later do they find out they've overpaid for their business. Some of the problems, though, when you talk about the lenders, is sometimes the lender is inexperienced. They don't know that the deal is bad. They're not able to give that feedback or advice. They may not want to give advice for liability reasons. I've had bankers before that I know have told people, sorry, you've been denied, we don't want to do the deal. And then they don't want to share why, when in fact they could help protect that person from making a bad deal. And they may only be considering cash flow with respect to debt service. So I put here gas station example because I dealt with a case once where a buyer overpaid for a gas station by about $300,000, and they did so with a loan. And when we went back and looked at it, it was obvious to me that the lender simply looked at their ability to service the debt, not the overall deal. And the way that they got away with overpaying was by having a bunch of extra money on their own. And in an extreme example, I was actually dealing with a client in California who bought a business and then they were trying to sell it. And when they bought it, they way overpaid. And the bank that they got a loan from actually considered her husband's income in the debt service calculation. So the banker found a way to get the approval done. And in doing so, really put them into a bad situation where they had grossly overpaid for this business. Now, why is there such a lack of common knowledge when it comes to buying and selling businesses? My training as a CBI came from the United States, and there's a ton of information in the United States about buying and selling businesses. And the reason it's such a big difference is that in the States, they have this thing called a 1031 exchange. And what it allows people to do is to sell a business, and if they take the proceeds of that sale and put it into the purchase of a new business, they don't pay tax on the gain. It's deferred. And then when they get to the end of their career, after they've flipped many businesses, they then have the tax consequence of all those gains through their life. We don't have anything like that in Canada. So it makes very little sense for anyone in Canada to sell a business that's good and then buy another one. If you have a good business, you hang on to it. And so because we don't have tax incentives that are causing people to flip businesses, very few people have experience with it. For most people that are selling a business, it will be the first time and the only time they'll ever sell a business. And for people that are buying, oftentimes they've never done it before. And if they do successfully buy a good business, they'll never do it again because they'll simply keep that business until they get to the point where they, in turn, want to become a seller. And so this is why there isn't the same degree of common knowledge about buying and selling businesses as there is about buying and selling houses, for example, or cars or anything like that. What exactly is it that buyers are buying? And this is where some of the confusion can come in when people are looking at a business. So, for example, are they buying retained earnings? Is it stuff, goodwill, cash flow, inventory? The answer should be cash flow. When I owned my business brokerage, people used to come in and they used to say, Dave, I'd like to buy a business. And I would say, great, what kind of business do you want to buy? And they would say, well, I work for the phone company and I earn 70 grand. So I think I need to buy a business that will earn me 70 grand. And that's what it is that they're buying. And here's where it becomes confusing, because a business buyer who is inexperienced or uneducated, they can easily be fooled into something like this. Hey, here's a Pizza Delight location. It cost $500,000 to build. And while it's not making a lot of money, the seller's willing to sell it for $200,000. Therefore, it's a good deal because it's so much cheaper than what it would cost you to build it new. And so the buyer's being convinced to look at it from the point of view of the cost versus the point of view of what exactly are they buying, what's the cash flow. And so even with a drastic reduction in what the cost is, you can still end up in a crappy situation where you can't service your debts. Every business out there is going to have financial statements of some kind, whether it's internally prepared or it's done by an accountant or it's just for a tax return. And in small businesses, we often have to do a normalization because small businesses are often managed for the tax benefit of their owner. And you guys have probably seen this over and over again. So you got the foundation contractor who has a tax return that says he doesn't really make any money, but he drives a fancy new truck and he goes to Florida every year. And it's because he's doing all this under the table business. So when a buyer comes along, that seller is going to share this story of all these things that they're doing, and they're going to try to make the business look as good as it can because they want the buyer's money. So we often have to go through a process of normalizing these financials. And there are some people who will, of course, be very aggressive with their normalizations. So they're going to try to add back things that really shouldn't be added back, or they're going to try to inflate the revenue numbers to make the business look a lot more profitable than it is. And it may or may not be true. We don't know. But here's the problem, is that without a proper mechanism for protecting the buyer, it can be dangerous because a buyer leaves themselves open to fraud. And this is what I'm going to teach you guys today, is how to create the mechanism to protect the buyer, which by extension is going to protect you guys as lenders. And this is something that the commercial banks have been doing forever. And some of you guys with banking experience are going to be able to maybe share some stories, but this is where we're headed today. So what kinds of levels of cash flow are we talking about? Well, there's two levels of cash flow that I'm concerned about for our conversation here today. The first one is EBITDA, which is the earnings before interest, taxes, or interest, taxes, depreciation, and amortization. So it's not a true cash flow figure, but it's a baseline that we can use to compare one business against the other. And the other level of cash flow is what we call seller's discretionary earnings, which is the EBITDA, and then we add back the fair market value of the owner's wages. Okay, and so and the owner's wages have to be adjusted for fair market value. That SDE figure, this is what a buyer is buying. They're buying this cash flow of money to them that they are going to control. They're going to have discretion over how the money is being spent. And what I often tell people is that they need to get three things out of that seller's discretionary earnings. They need to, number one, get a salary to live on, and it should be in line with the market value of doing the work. So if you're going to be managing a pizzeria and a person should earn 40 grand for managing a pizzeria, then the owner should, right off the top of that SDE number, be able to take a $40,000 salary for themselves. Number two, there needs to be a return on their cash investment. So if they put in, 30 grand of their own cash, they should get a return on that money commensurate with the risk. So like 20, 25%, like it's got to be in line with the risk. And then there's the debt service. And I'm sure that you guys can tell me, I was talking with a banker yesterday, actually at a credit union, and he was just telling me that he had seen his fifth business plan in a row that said that the owner of the business wasn't going to take a salary in the first 2 years, which begs the question, does that mean they're not going to eat for the first 2 years, right? It's just not realistic. There has to be some allowance for a person to take money out of the business. Otherwise, what's happening is the business isn't actually supporting the price that's been arrived at. And then number four, hanging down there, is CapEx, because the SDE is derived from the EBITDA, and the EBITDA takes away depreciation and amortization. And in some businesses, you've got equipment that's old enough, it's not even being depreciated anymore, right? And then the question is, what else has to be accounted for in our go-forward projection? So is there equipment that hasn't been looked at in 20 years that needs to be replaced? Are we going to have to buy some other stuff? And what I typically tell most buyers to do is to use something like leasing as a proxy. So if you know that there's 3 pieces of equipment that should probably be replaced, what we'll do in our projections is we'll add a lease payment, assuming we're going to acquire and lease those 3 pieces of equipment. Maybe we'll add one in each of the first 3 years, and we'll see how that expense affects our cash flow going forward. The bottom line is this, is that the buyer's buying a cash flow, and they'll pay a price that makes sense given the risk of that cash flow continuing with the business under their stewardship. The problem comes from the fact that many buyers become overly optimistic, and they don't understand the risk of the cash flow continuing under their stewardship. And so if the buyer is lining themselves up to do something really dumb, we have to make sure that they don't take the CBDC's money with it, okay? So let's take a very special look at some particular issues relating to franchises, because they really do exist in a special category of hazard for you guys as lenders. So when you have a franchise that has a physical location, what I'm seeing more and more is that the franchise will use what's called a head lease. So the national franchise company will lease a location, then they'll sublet it to their individual franchisee in the local market. And the challenge that presents for you guys as lenders is that it gives the franchisor an added degree of control over the location at your expense and at the expense of the franchisee. There's also certain predatory strategies that I'm going to be showing you guys in a story that's coming up here in a couple slides, and equipment inflation. So back when I had my business brokerage office, I also got myself certified as a machinery and equipment appraiser, and I've done many evaluations for the big 6 banks, for credit unions, the BDC, etc. And I was once hired by a lawyer out of Toronto because he was engaged by one of the big banks to foreclose on someone who did a small business loan in Prince Edward Island. And it was for a business that was going to go around and recharge fire extinguishers, okay? So this guy bought a franchise, paid a franchise fee, the business came with a trailer full of equipment. And that thing that is shown on the screen is a device that helps refill fire extinguishers. And the franchise company charged the guy $2,900 for that thing. And when I went over there and I did a survey of the equipment that was in the trailer and made a list and cross-referenced it with the invoices, and then I went and actually did an appraisal, I found that you could buy those things online for about $800 US. Okay. So not only did the guy pay a franchise fee, he paid an incredibly inflated price for all of the equipment in the initial startup package. And the lender, they just looked at the invoice. They made their lending decision based upon what they thought the equipment was worth, given that most equipment is bought in an arm's length kind of transaction. In this case, it wasn't an arm's length transaction. The purchase of the equipment from the franchisor was tied to the guy buying the franchise. And so you can almost say that they had an extra level of franchise fees through this inflated price that they charged on some of this equipment. And I asked the question down there, what can you do to protect your institution from these risks? And I'm going to give you an example of what some of the other banks are doing in a further slide when I get into the story. But additional reading, I've got a whole book called Franchise Warnings. And if you have somebody who's looking to buy a franchise, I would recommend it, because it's basically a whole book full of the stories and experience that I've come across personally, where franchisors have taken advantage of franchisees and screwed them over in different ways to get money out of them. The golden rule of thumb that I always talk about with business buyers is that because businesses are nonlinear systems, which means that a change in the top line is not the same as the change in the bottom. So for example, I could have a 10% decline in sales, which could equal a 70% decline in profit, right? So because it's a nonlinear system, it's extra sensitive to changes on the top line. And for a business to have an increase in sales of 5% in 1 year is pretty reasonable. But to have a decrease in sales of 10 sometimes or 15% is also something that can happen regularly. So if banks are asking apartment investors to have a debt service coverage ratio of 1.25, it's perfectly reasonable for us to want a business buyer to have a debt service coverage ratio of 2, meaning that after they take home some money to pay themselves, there should be in the demonstrated plan, so last year's results, more than twice as much money available than is required to service debt. So that if there is some kind of bump in the road, that the person's actually going to be able to make their debt service payments. Okay? Price allocation. When the business is being purchased, a lot of the times for small business purchases, it's going to be an asset deal. If you get, all these sellers, they want to do share deals because they're told by their accountants that they're going to get this money tax-free. And the reality of the situation is that if someone's been fiddling around with under-the-table sales and not recording things properly, putting personal expenses through the business, if they manage to get as far as the lawyer is going to tell the buyer, like, you're crazy to buy this business because of all these potential liabilities with Canada Revenue Agency. So we're going to buy the business as an asset deal, and that means that the purchase price is going to be allocated. So if it's a $100,000 purchase, we're going to say that $30,000 is going to go towards the goodwill, $40,000 is going to go towards the equipment, etc. Buyers and sellers know that they can't get financing usually for goodwill. So what the buyers and sellers will sometimes do is they'll collude together to inflate the values of the other things. I once did a deal for a bottle exchange location, and I was brought in by the lender as a certified machinery and equipment appraiser. And the buyer and seller had a list of equipment, and it was $50,000 or $60,000 worth of equipment. My appraisal came in at $18,000. So those guys were trying to convince the lender that there was more stuff in the business because they wanted the lender to make a bigger loan on that stuff so that the buyer could get more money and the seller could walk away with cash at closing. And then, of course, there's a whole list of different kinds of stuff that is going to end up being collateral for you guys. And here's the thing that I was talking about earlier, the structure. So how does a buyer protect themselves from a seller who claims that the business is different from what was shown on the tax returns, or claims that all the customers that are there are good, or claims that there's a great opportunity for this business? The way that the buyer manages risk is through the structure of the deal, through making the seller finance part of the transaction. And so when somebody buys a business, here is normally how it's done. The buyer puts in some money, there's skin in the game, right? They borrow some money from a lender like you guys, but they always require that the vendor be part of the financing package. And it protects the interests of the buyer, and it protects the interests of the lender in a couple of different ways. But let me just stack them as boxes so you guys can see this visually. So on the left-hand side, in the pink boxes, we have the things that are being acquired. So there's capital assets, there's operating capital, and then there's goodwill if it's a profitable business. On the right-hand side, in the green boxes, we have, proportionately in size, the sources of the capital to make those acquisitions. So capital assets, buildings, equipment, machinery, vehicles, we finance those long-term assets with long-term debt, leases, mortgages, loans, etc. That operating capital component largely is satisfied with the buyer's cash, and the goodwill, we pile on top the vendor financing. The seller financing is critical to protect the interests of the lender and the buyer. And I've got a couple of slides here where I break this down so you can understand. Because one of the things that we put in the vendor financing note, if it's structured properly, and this requires proper advice for the buyer and proper legal advice, is we always put a clause in the vendor note that says, this note subject to offset in the case of an undisclosed or undeclared or undiscovered lien or material misrepresentation. And what that does is it leaves the door open for the buyer after the purchase. If they discover that they were misled or lied to or something wasn't disclosed to them, the door is open for them to offset their losses against the money that they owe to the seller. If I bought a factory and paid $1 million and just wrote a check, say I borrowed from you guys and I wrote a check. If I discovered a few months later that one of the forklifts was actually leased, the guy from National Leasing is going to come and he's going to say, I'm here for the forklift because you're not making your payments. And the buyer would say, but I thought I bought the forklift. It's right here in the purchase and sale agreement. And he would say, no, here's the lease contract. It hasn't been paid out. So what's a buyer to do? If he called his lawyer would say, well, we're going to sue the guy. Well, now the buyer has to engage his attorney. They have to find the seller. They have to sue him. They have to obtain a judgment. Then they have to hope they can find assets to attach the judgment to. It's a lot of risk, a lot of time, a lot of expense. Whereas if the buyer bought the business for $1 million, gave the seller $600,000 on closing, and the other $400,000 was going to be paid out with interest over 5 years, when that guy came from the leasing company, we just write him a check. Here you go. Here's the money you're owed. And then we write a letter to the seller and we say, look, you never disclosed that the forklift was leased, and we have now suffered because we had to satisfy this liability. And we're either going to deduct this amount of money off of the note, or we're going to deduct this amount of money by not sending the next 3 payments. And in that way, the buyer is always in a position of power should something arise after the deal. And that's how we structure these things, so that the buyer is protected, and by extension, the lender gets protected at the same time. I'm going to get into that in a moment here. But why should the seller even agree to that arrangement, right? Why would they want to? Well, here's a whole list of reasons of why they have to agree to it. Number one, it allows for quicker deal closings, because oftentimes the problem the buyer has is they can't get their hands on all the money. So if the seller is willing to finance part of it, the deal happens more quickly. It allows them to get a fair price. Oftentimes the seller they can't find a buyer who has all the money. They end up accepting a lower amount because buyers can't put the whole purchase price together. By doing seller financing, the buyer doesn't have to, right? They can just, knowing that they're going to have to finance part of it, they can offer to do that in the process, and they get the quicker closing, they get the better price. It allows them to earn better returns than most other investments. Seller notes can be at any interest rate that the buyer and seller agree to. It lets them keep an interest in the business. And this last one is the one you guys should pay attention to, is often necessary because buyers in the market for the business simply don't have the cash, and many times lenders require it. Over at the commercial banks and at the BDC, very often when the approval comes back for the loan, it comes back with, and we need the seller to finance part of this deal as well. Here's the next slide. Why do buyers need the vendor take back? Number one, it aligns the interest of the seller with that of the buyer. So now both parties have an interest in the business's success. If the buyer pays the seller all cash, the buyer just runs away. They have no reason or interest to be supportive or helpful to that buyer after the fact. It creates accountability tool. So again, if the seller lied about something, we have a recourse, a way to get back at them. Provides financing that may not otherwise be available. And here's this last one is interesting. An easy transfer of unorganized liabilities. I was asked to consult on a case in Western New Brunswick where a guy bought a motel and restaurant, and the seller had sold a bunch of gift certificates, never disclosed it to the buyer. The buyer took over the business, paid all cash, and all of a sudden these people start showing up with gift certificates. And so basically he was suddenly forced to accept a liability of the previous owner, even though he had no idea he was going to be. With a vendor take-back financing in place, he would have been able to accept those gift cards and then submit them to the seller as payment for the note, because the seller received the money already and never had to deliver the service. Okay, so these are all reasons why this strategy, this structure of how you finance a business has been with us forever. And when I obtained my certification down in the States, it was 2009. I was looking for the plaque on the wall. It was 2009 that I got that. That designation had been around for 40 years, and I was the first person in New Brunswick to ever obtain it. And so this knowledge and this understanding is not new. It's been around for a long time, but because we don't do a lot of this in our everyday lives, it's taken forever for this kind of information to really start to get into the market here. And normally when I talk to buyers and sellers in the Maritimes, they've got no idea about this kind of stuff, that this is how these deals are often structured. And then it says, remember those cash sales. The vendor financing subject to a certain sales level is often called a sales warranty. So I once sold a pizzeria where the seller claimed that he was doing a huge volume of under-the-table business. And so what we did in the arrangement is we worked out this table that said if the buyer's sales weren't a certain level in the first 6 months, then there was a certain discount to the note. So basically the seller guaranteed that the sales were going to be at a certain level. And if they didn't end up being at that level, the purchase price changed after the fact because the note liquidated itself if the sales weren't achieved. So there's all kinds of advantages we can do here. Why lenders need vendor take-back. So this is what's in it for you guys. It ensures the continued interest of the sellers who are in the best position to coach the buyer. So if the seller hasn't received all their money, they want the buyer to be successful because they want to collect all their money, which means that the person who knows the business better than anyone is available to help the buyer, which is certainly in the interest of a lender, right? The next thing is that number two, it creates a de facto guarantor on the institutional debt. What does that mean? Well, I'll give you a direct example of something that happened here in Moncton. So a guy bought a business and he borrowed from a couple of different institutions. He got a BDC loan and he got a loan from a bank and he got a line of credit from a bank. Ran the business for a couple of years and he also owed about 150 grand to the seller. So after 3 years, he got into trouble. He defaulted on one of his debts. The banker knew that the seller was still owed money. They called the seller and they said, you better come in and help this guy. If we foreclose on this guy, you're going to get nothing. And we know that you're owed money. But if you want to come in and take the business back, just stop by my office. I'll let you sign the note. Because what does the lender want? more than anything. They don't want to foreclose on a business. The lender wants the money, right? And so for the lender to know that there's somebody else out there who's at risk of losing out if the buyer fails, it means that that person can come back. That person knows how to run the business. That person can take the business over again and take on the debt that was acquired to purchase the business in the first place. Because the money that you guys are advancing to these buyers is being given to the seller. So the seller is already sitting there with most of the money from the sale. And if they come back and take the business back without paying another dollar, just assuming the debts that are outstanding, they basically get the business back. If they can fix the business and sell it again, you guys will be paid out in full on that sale. So there's all kinds of advantages for the lender in making sure that the seller finance is part of the deal. And that's why commercial banks demand it in a lot of cases. They say, this is subject to the seller holding paper on the deal. Using deal structure to fit the golden rule. So if the debt service coverage ratios can't be met, maybe we can get some of the debt to start to act like equity. So the BDC does this, and I have this on the next slide. But we can do deferred payments, we can do payment holidays, we can do deferred purchase of certain items, we can get creative in a lot of different ways. I once did a motel deal where the buyer wanted to preserve his cash to renovate the motel. So instead of buying it and borrowing money, he got the seller to lease him the motel while he renovated it, and then he was able to borrow against it at a higher price. And so that flexibility, these different kinds of deals, we can do this with the vendor notes as well. For example, over at the BDC, they have a trick where if a seller will agree to not accept any principal payments on a vendor note for 60 months, that's 5 years of no principal payments, then the bank will consider it equity. And because they're concerned about that debt to equity ratio, and the reason that lenders are concerned about debt to equity ratio is they don't want the buyer to commit to a lot of debt service payments, which will drain cash out of the business. If a seller agrees that part of the money will only be due to be paid in 5 years' time, it means that the buyer has 5 years to operate the business, pay down the other debts without the drain on that big seller note. They get 5 years of reprieve before they have to start making that payment. It also gives incredible confidence to a buyer. Can you imagine if I'm trying to buy a business and I've never owned a business before, and now all of a sudden I've got a seller who agrees, hey, I'll finance part of this because I know you're going to be successful. It gives them confidence. And I often tell buyers, if a seller won't finance part of the deal, it means one of three things. It means that simply they're just ignorant. They don't know this is how businesses are sold. Or number two, they're worried they won't get their money because they're lying about something. So that's, someone trying to perpetrate a fraud. Or number three, they're worried about not getting their money because they don't believe you can run the business, which in my mind is a good reason not to buy one if the seller doesn't think you can run it, because they know the business better than anyone. So let's get into some examples. The fixture dealer sample is the one I just told you guys about, because in this deal, the seller actually had to split their seller note into two. So part of it became a 5 years no payment note, and the other part of it was payable immediately. And the reason why part of it was made into the 5 year no payment note was so that the debt to equity ratio wouldn't exceed 3-to-1, which is what the other lender, a commercial bank, demanded on the opening balance sheet. So let's look at anatomy of a bad deal. And these are the kinds of things I see on a regular basis. And this just happens to be a franchise restaurant, okay? So the restaurant does about $750,000 in sales, and the seller's discretionary earnings is about $80,000. Buyer came to me, wanted me to help analyze the deal. I did research. I found that similar businesses were selling for about 1.74 times SDE, meaning the business, the cash flow, was worth about 140 grand. Okay. The asking price was only 125. Holy cow. My heart's a flutter because we have a reasonable asking price on a business. Except it wasn't, because here's what we found out next. The franchisor said, that any new franchisee was going to have to add the second brand that they were busy trying to sell to their franchises. And that was going to cost the buyer another 30 grand. And then there was a training fee that the franchisor had to charge the new owner to train them in the system. That was another 10 grand. And the store was over 10 years old. It had to be updated to the new decor package, which was a $60,000 cost. Okay. So in addition to buying the business from the seller, the buyer was going to have to pay all of these fees in order to get the business in their name and get it operating. And the franchisor assured the buyer that if they did all this stuff, their sales would go up by 20%. And what I advised my buyer was this: the cash flow is the cash flow. It's worth 140 grand. We know that. If we have to give 30,000 to the franchisor and then another 10,000 to the franchisor and then another 60,000 to a contractor, it still doesn't change the value of that cash flow, which means we can only give 50 to the seller and still acquire that cash flow for its true market value. And so that was the offer, $50,000. What do you guys think happened as a result of this? Well, the buyer didn't end up buying the business. He was shocked at first, and then later, after talking with me, realized why this was the case, why he couldn't offer any more than 50. The business broker that was trying to do this deal, thought we were crazy. Oh my God, you can't buy a business like that for 50 grand. And I explained, we're not buying it for 50. We're paying 140. We're only giving your client 50. What did the seller do? The seller didn't do anything. They didn't accept the offer. And what do we think happened? Nothing happened. Because let's face it, if sales were guaranteed to increase by 20%, which the franchisor claimed, then why on earth didn't the seller do those renovations? They knew that it wasn't going to improve the business, or they weren't willing to take the risk. So why should the buyer have taken the risk, right? So that location is still operating and hasn't been renovated to this day. Here's another example of a raw deal for a lender. This is my Muffin Lady example. So in this business, the asking price was 139 grand, and the buyer offered 125,000 with 75,000 down and 50,000 over 36 months. So a standard deal with vendor take-back financing. And in this case, the seller told me that her accountant said that she shouldn't do the deal. I don't believe that's true. I think that she knew her sales were declining and that she didn't want to be on the hook for any vendor financing, because 14 months later, the sales fell by about 40%. And then I found a new buyer who offered 59 grand, and she wanted to accept the deal to get out. Here's what happened for the franchisor. The franchisor wouldn't let her accept the deal. She was behind in her franchise fees, so they seized the location from her for defaulting on her franchise fees. They took over the store location, and then they called her bank, who was owed, I think it was $60,000 or $70,000. And they basically said to this lender, actually it's on the next slide, it's 80,000. The franchisor called the lender and said, look, we know that you have a lien against the equipment that's in there. We will buy it off you for $5 grand, or you have 24 hours to remove it. That was the Bank of Nova Scotia. And so what did the bank do? They just took the $5 grand and they got screwed out of the 75. It was a CSBFA loan. So really the taxpayers got screwed in the end. So the franchisor seized the location because they owned the head lease. So they were ultimately in control of the real estate. They changed the locks on her, kicked her out. She ended up going bankrupt because she wasn't able to get cash to satisfy her debts. They got all the equipment for $5 grand. And then they called me and said, would you finish that deal, please? We'd be happy to sell this location for 59 grand. And this is an example of how a franchisor was able to screw the lender and the franchisee in doing this deal. Now, I told you guys earlier that I was going to talk a little bit about some of the things that lenders are demanding of franchisors now. I have a good friend at one of the big 6 national banks, and what he was telling us is that they actually now have a master deal with a franchisor where they're guaranteeing the loans of their franchisees because they need to have access to capital for their franchisees in order to build new locations. And they gave me one example of one of the franchisees actually failed and the store closed, and the national company wrote them a check. So the bank now is assessing the risk in a completely different way because the franchisor is guaranteeing them. Here's my suggestion to you guys. If a franchisor is in a position where they're able to seize assets for next to nothing, then should they not be somehow involved in the transaction, just like a seller is or anything like that? And I've often suggested to bankers that they should ask franchisors to maybe guarantee the loan to the amount of their franchise fee, for example, because they're walking away with that money in exchange for delivering a little bit of training and a couple of manuals most of the time. And with that, that's the end of my presentation. And I'd be happy, sorry if it felt rushed a little bit there. I know the time was getting on. If anyone has any questions, I'd be more than happy to field them now. Thank you, Martin. Anyone want to unmute themselves and ask a question maybe, or share a story and get my commentary on it? Does everyone understand how the vendor financing plays such a key role in protecting the buyer and you guys? One of the last ones that I saw myself was just from a month ago, and it was an approval from a lender, and they agreed to finance a bunch of equipment. It was about an 80% financing, and one of the stipulations on the term sheet was that the seller had to do a seller carryback note of $30,000. So it was basically the lender was prescribing this is how the deal has to look. And in my career, I've seen it over and over and over again. Even if the seller doesn't want to do it, the buyer comes back and says, hey, great news, I got the financing, but we have to change the deal. And a lot of the times it's just the sellers don't even know that this is the kind of thing that's normal. And unfortunately for a lot of sellers, because they don't know this, well, they try to sell their business for years and years and years, and they end up reducing the price, because that's what we do with real estate, right? If we don't find a buyer, we keep reducing the price to the point that we find a buyer. For business, I often tell sellers, don't reduce the price. You want to price it right. You simply make financing available in order to make the deal happen. Thanks, Jennifer. That's a great comment there. And she says that they're in the process of doing a deal with the BDC, and there's vendor financing on the table there too. So I'm going to hang on here for the next couple of minutes if anyone wants to talk. But thank you very much for joining, and I'll stop the recording.